Good morning, everyone. Thank you for coming to the session. I've brought a few colleagues along from Credit Guarantee to kind of back me up, and especially in question time. So thank you for your participation, and I hope that you find the session interesting. So the theme for today is, we hear a lot about Africa rising, but is it more a case of, Africa risk rising? How do we see the continent? Is it something that we should be running away from? Or do we embrace the Africa story as being full of promise? So that's really the basis of the talk today. I thought I'd just tell you a little bit about what we do in case you're not sure. Trade credit insurance is a form of short-term insurance. Our policyholders mainly deal with us through brokers. And what we're insuring is our policyholders against non-payment by their customers, or what we call the buyer in this particular transaction. So the policyholder sells to the buyer doesn't pay for a whole variety of reasons. I'll explain in a minute, and that's where Credit Guarantee steps in. We do this class of insurance right across South Africa and then also up into Africa. In fact, we underwrite 146 countries across the world, but the focus of today's address is really on selected companies in Africa. So we like to become part of our clients' credit management effort. Trade credit insurance is not meant to replace what clients do in terms of proper credit procedures when they sell to a particular buyer. We're there to protect against the unforeseen. It's also very much about supporting the client's growth into Africa. So Africa can be a daunting proposition for clients. They don't know the market, they don't know the country. There's a whole variety of political risks in that country. And then maybe the information coming out of the country, and in terms of companies trading there, is not of a very good standard. And that's one of the particular challenges for Africa. This is a glossary of terms. I can come back to it, the basis on which we deal with our clients, but I think I've given you the basics, so let me move on. So if I were to give you a risk covered dashboard, red, amber, green, the sorts of risks that we're covering, which ones are flashing red, which ones are flashing amber, and which ones are pretty much the same. So as an example, contract repudiation, we haven't found this to be a growing risk in Africa, but very much a top-of-mind risk at the moment is this issue of conversion and transfer. What's meant by that is our policyholder supplies goods to a buyer and then finds that the buyer is unable to pay for the goods because of a shortage of US dollars, typically, or dollars are rationed in that particular country, or there's some other reason that you can't actually bring money out of that country to settle the debt. So that's a big flashing red for us. And then insolvency, bankruptcy, as well as protracted default. When we talk about protracted default, it's just that the buyer can't pay or won't pay, and a period of at least 6 months elapses, and our policyholder, looks to Credit Guarantee to make that good. So I thought I'd just highlight some of the issues, and I'm going to talk about what's just out of scope of cover. We sometimes get approaches to provide retail credit to private individuals, so we don't insure private individuals. It's very much a business-to-business type of transaction that we're looking to cover. What's out of scope for us is doing the business that the banks do. That's providing cover for banks on lending portfolios. We don't do that. It's really a flow of goods or services, typically between a South African exporter and an importer sitting in Africa. It's that type of transaction that we want to underwrite and provide protection against non-payment for. These are the liquidations and insolvencies stats for South Africa, just by the way. And what almost looks a bit paradoxical is, despite picking up the newspaper each morning and seeing a whole lot of bad news about the economy, the official government stats are actually showing that insolvencies and liquidations are on the decline. But notice the steady rise in business rescue cases. Business rescue hasn't been around a long time as a mechanism. It's like a rehabilitation mechanism for companies to get back on their feet. And we've had some high-profile cases in the press on business rescue. So slowly rising. But I thought what you'd like to see is this. It's a chart of what we call adverse events. So when adverse credit events, so when our policyholders talk to us about what they're experiencing, customers not paying, customers slow to pay, or a customer's approach them to say, look, I need more time. I was going to pay you in 60 days. I now need 180 days plus to settle the debt. These things would get reported to us, or we pick up information from the credit agencies, or we have our own networking type events, and we log all of these onto our system. So this is over quite a long period of time. Left-hand side of the slide is 2007 up to the present day on the right-hand side. And I think what's interesting to look at on this graph is this cone of volatility that sort of seems to be widening, which started really around the beginning of 2013, where we see big swings in the amount of these adverse credit events reported to our company. And you may ask, why is that? We've spent a lot of time thinking about it, but I think the reason will become apparent as I go on. So the focus is just what has falling energy prices and commodity prices done to trade in Africa, and what sort of risks has it brought about. So this is a commodity price index from Bloomberg. It's a basket of 22 commodities and looks back to, the graph goes back on the left side to 2010 up to the present day, and you can just see the slide in commodity prices. Three components there is the price of crude oil, which has gone down by around 60% since January 2014. Copper's fallen by about 34%, and iron ore's come off by about 60%. You can see at the tail end of the graph a little bit of an uptick, so things seem to be getting better. Not a whole lot better, but there are some signs that things are improving in the commodity world. But certainly you can see well down from the lows. So what has this meant? And now just to look at a couple of commodities, this is iron ore. Now what's very interesting to see here is that this sharp decline started in January 2013, which is more or less when we saw our adverse cone of uncertainty start to spike up, quite dramatically. Part of that reason is that we as a company have quite a big exposure to the steel sector, but the steel sector hasn't been a pretty place to be, either in South Africa or for the rest of the world for that matter, mainly as a result of slowing demand in China, which has meant that the steel prices come off and the iron ore prices come off quite sharply as a result. Crude oil, is a story. This has benefited some industries, like the airline industry is actually pumping profits at the moment, so they're a real beneficiary. But many countries in Africa are very dependent on oil for foreign exchange for their earnings, and this has had a big impact on those countries. Just on credit ratings, the countries that I'm focusing on have all really shown a deterioration since July 2011 up till now. So we've seen the rating agency downgrade many companies, many countries, some quite dramatically. So Mozambique at one stage was the darling. People were talking about Mozambique becoming the next Qatar, and now at the moment it's on CCC negative watch. And growth rates, I won't go through the figures on the slides, but growth rates have come off quite dramatically across Africa, pushing up the credit risk profile. Interest rates have gone up, as shown by the sovereign bond spreads. And I'm just going to give you a perspective on a few selected countries so that I don't go into too much detail. So the countries on the slide, which I've highlighted in dark, I'm going to make a bit of commentary on those countries. These are markets that South Africans are eyeing as they look north. And our experience in these countries has been quite a mixed bag. Some are actually winners and some are losers, and as you'll see. So Nigeria, a very big market in Africa, has shown a big slowdown in their GDP, a big slowdown in oil production as well as oil revenues, mainly as a result of there's militant activity in the oil-rich regions. And then what we've seen is some quite severe fuel shortages. Paradoxically, Nigeria is the world's 5th biggest oil producer, but they have shortages of fuel, shortages of electricity, policy uncertainty, security threats. So it's been a very difficult market. And what we've seen from our book is we've paid some claims in Nigeria. We had a good run for a number of years, but the typical story you'll find in Nigeria is Nigerian businessmen get used to operating in a very, very difficult economy. They find workarounds. So they find a way to secure some electric power that, and almost get a priority allocation of power. They find a way to get fuel when it's not freely available to everyone. But under current conditions, we found that buyers have said, we just can't really work around this problem anymore. We've now got to switch off the operation, wait for better times. So it's really repayment proposals not being met. And I guess the message here is if you're dealing into Nigeria, to look at the companies, the sector they're operating in, the challenges the sector faces, and whether the company that you're dealing with can survive those challenges. This is a bit of a cynical slide. It's looking at Nigerian foreign exchange reserves from 2012 till 2016. And I put in a Pac-Man there in September 2015. Well, you'll remember one of our large telecoms operators operating based in South Africa was fined $5.2 billion. So I'm sure it was just a coincidence this fine came at a time when Nigeria was running out of dollars. And I'm sure I'm just being cynical. Anyway, that's what we saw. Just for interest's sake, a $5 billion fine is approximately 25% of the Nigerian annual government budget. So it's a really big number in relative terms and even in absolute terms. So that's just a thought that occurred to me looking at this graph. Angola, parts of Angola are flying. Southern Angola, lots of trade into Namibia, fast-moving consumer goods. That belt of the 3 O's, the Oshikati, Ondangwa, and there's a third one I can't remember, but that's a really thriving hub, cross-border trade going on big time. Angola, as you know, also a very oil-dependent economy, and with the prices coming down, a lot of stress is coming to the system. Angolan growth has fallen out of bed down to less than 1% forecast for 2016. There's also been an approach by Angola to the IMF for financial assistance, and the IMF have offered a $4.5 billion loan to the country. So difficult conditions in Angola. What we find is a number of the companies trading in Angola are in fact subsidiaries of strong offshore parents, and in that case hasn't really given us as credit guarantee an issue. I think caution should be exercised in dealing with local companies. There is quite a lot of stress in the system, and access to dollars. So if the company you're dealing with in Angola has an international parent with operations elsewhere in the continent or elsewhere in the world, they have another source of foreign exchange to bolster the corporate treasury, then that's fine. If they're just totally dependent on Angola, exercise some caution. Ethiopia is a very strong success story. People normally associate Ethiopia with drought and problems. Yes, they have had a drought in 2015, which was hammered their growth rate. But other than that, the economy is very well diversified. Lots of public sector investment in the short and medium term is going to underpin that economy, and we see infrastructure bottlenecks in Ethiopia getting better. So the country is doing well. From our underwriting point of view, we've got no particular risk issues to report, and Ethiopia is one of the bright spots on the continent. Kenya, also a well-diversified economy. So Kenya very much less, not as diversified the economy away from commodities and energy prices, so they haven't felt this effect. There's a little bit of government instability going on in Kenya at the moment. Security has been beefed up to support tourism. I was in Kenya recently. You remember they had an airport fire which took out the airport in Nairobi. They're well down the track to rebuilding that particular airport. There was terrorism activity in a shopping center you remember reading about. If you travel in Kenya, lots of security presence. You can't enter a shopping mall without going through metal detectors. You can't go into a hotel without going through security. So it gives you a sense of comfort. We have had one large claim come out of Kenya where the government expropriated a piece of critical infrastructure of one of the buyers of one of our policyholders, which gave rise to some difficulty. So maybe the lesson in Africa is governments, even in the more stable countries, can still behave a bit erratically, and it's prudent to have some political risk cover against, risk events that could happen on an unforeseen basis. Mozambique, I've already referred to. So some rise there in political tensions. We've just come back from a visit to Mozambique. So there's a bit of a rise of Renamo again, tensions in the country. It's also a bit of a kidnap and ransom hotspot. And business practices can be a little dodgy. So one of the large claims we paid there was on a wholesaler who was selling fast-moving consumer goods into that market, and very successful, actually, trading quite well. And then just overnight, stock disappears, the owner of the business disappears, and our policyholder in South Africa is left high and dry, and not only with a loss of the debt, which is not recoverable, which we made good, but also a hole in their turnover, because to find another reputable distributor in Mozambique is not all that easy. So some pressure in that country too. Zambia and Zimbabwe. Well, Zambia is a lot of copper activity, copper mining activity. The copper price has come down quite substantially, but there's a good, strong agricultural sector. Electricity supply deficits are part of the order of the day. You see the same sort of pattern in Zimbabwe as well. We underwrite risk in both those countries cautiously, again, it's a case of companies have almost got used to working around the system to make sure that they survive. So we have a cautious country ceiling on Zambia and Zimbabwe, but despite the severe stress, we haven't seen any big claims come out of those two countries. Things seem to be ticking over, but at a very low level. Tanzania, the last company I'll refer to, another high spot, as growing very, very nicely. They had peaceful elections in October last year, and the government has a 5-year plan. It looks very credible. So the country's holding up well. A good, strong economy, diversified away from commodities. We don't have any particular issues to report there in Tanzania either. South Africa, I can see that many of the speakers in the other workshops are going to talk at length about South Africa. So I'm just going to highlight two things which are on our minds. The one is the rise of fraud as a cause of corporate failure, which is of concern to us. And the other is work which we're doing to support the SME sector, the small businessman, to help with this cause of job creation and inequality. So there was this report in June 2013 of the body of the owner, the principal founder of First Strut, found next to his pink Bentley, next to the highway, death in almost Secret Service type circumstances. And then shortly after the founder was found dead, the extent of a fraud emerged, which was of staggering proportions. So you might have heard of First Strut, and it was really a 20-year Ponzi scheme which had been built up by the two founders, and people who worked for the company didn't realize what a Ponzi scheme it was. Money was moving around, there were shell companies, plant and equipment got financed many times over, even BEE certificates got forged, and when the company fell over, there was a shock, across the South African financial system. We ended up paying 200 million rand in claims on this particular collapse. The banks were in for very much bigger numbers. There was 925 million rand in corporate bonds outstanding, and there were 10,000 unpaid creditors when First Strut went down. So it's very difficult to underwrite for fraud. When we do our underwriting, we look at the financial strength of the company, what have the auditors signed off, what sort of financial returns have been put in. It's difficult if all of this is a huge, big fabrication and it's all made up and it's all make-believe. It's happened elsewhere in the world. a large bunkering company called OW Bunker. I think at the time was the second or third largest company on the Denmark Stock Exchange, collapsed, and it was, eventually down to fraud by some traders in Singapore that brought the whole company down. So we've seen a number of these events in the world. I guess the answer is know your buyer. There's no substitute for know your buyer. So know the people you're dealing with. And I'm not just talking about the routine checks that you might go through from a checklist point of view to satisfy, the internal auditors or group risk or something. It's meet them, understand what the business is about. Is it a real business? Are the trades real? Before you extend credit, just be sure of who you're dealing with. I'd like to just talk for a moment about small and medium businesses. These are businesses that really can't afford to take a hit. So they supply to a customer in a very difficult economy. And this is very much a top-of-mind issue at the United Nations. There was a big discussion about this at Addis Ababa. This fact that inequality in the world really threatens to bring down the whole system unless we're actively trying to do something about it. So we were worried when we saw the Shwani unrest unfold a couple of weeks ago. Ostensibly, it's got to do with local government elections, or so you would think. But you also have to consider that there are many, many people who suffer under injustice even today and have really nothing. So you have the haves and the have-nots, and that gap getting wider and wider. And so on small business, we find it very important for us to play a role in trying to protect the small guy against adversity, against a bad debt, which could otherwise bring the company down. We think there's about almost 700,000 such businesses across South Africa. They make a huge contribution to GDP, probably as much as 30%. But reliable data on SMEs is quite sparse. We think the typical profile of the companies that they have a debtors book somewhere between 4 million and 8 million. I see Abdul sitting over there who runs this division, and he would know better than me. Typically, those debtors are outstanding for 2.5 months plus. And then for the SME, he's normally got 4 to 5 customers on which he's heavily dependent. So unlike the large corporates who may have 4,000 customers and a good spread, the SME normally has a big concentration towards 2 or 3 buyers, and if something goes wrong there, it could have a very serious impact on the business. The risk profile is also quite different. In the corporate market, we tend to see companies get into trouble because of more of the macro things, so things are difficult in the sector. Or maybe the company's got itself into debt in the good times and now the times are bad. Or just demand in the economy is weak. Excuse me, those tend to be corporate risks that we underwrite. In the SME market, it's more things inside the organization, such as the owner gets sick, and he can't pay or he can't go to work, and he's a sort of a one-man band. Or the buyers that they're dealing with lack the capacity to actually execute the order. Load shedding has come up as a cause of claims, which normally the larger companies shrug off and they carry on. So load shedding, we even had Ebola cited as a risk, as a reason for a claim, where one particular one particular player in the SME market wasn't getting paid because the person who owed him money allegedly contracted Ebola. So you see a whole different portfolio of risks, and we're very focused on that, and we think we're getting it right. I'm going to wrap up now with a few conclusions and leave you with a few thoughts. I think the first thing is Brexit. What does this mean for Africa? It's a relatively new phenomenon. And someone asked me the other day, what does Brexit mean for credit guarantee and our risk profile? And the answer is, I don't know. But that's actually the problem, is we don't know. And it's just more uncertainty in the system, in a system that already has quite a lot of uncertainty in it, and a financial system that's already, creaking in certain places. So what does it mean? We think we don't believe a global depression necessarily. I think we'll certainly see some recession in Britain, and if that happens, probably weaker demand coming out of Britain for its trading partners in Africa, including South Africa. The pound is weaker. Demand out of the UK could very well reduce. Counterbalancing that would be the fact that in the EU they pay subsidies to farmers. That looks like it will fall away, in which case African farming could come more to the fore, supplying agricultural products into the UK. So that's what we hope will happen. There's a whole number of trade deals that have to be negotiated, renegotiated under a new legal system. Many pages of I think the lawyers are going to be gainfully employed for many years to come, rewriting trade agreements and contracts. So we're watching the Brexit development. Nothing immediate, but I think just something to watch. So is Africa risk rising? Are we shying away from it? The risk is rising, but we don't see Africa as a one-day game. On the right-hand side is an extract from a McKinsey report, which is just tracking how Africans and African nations feel about 2 years from now. Are things going to be worse or are they going to be better? And you can see in sub-Saharan, people believe things will be better for them at a household level and at a national level in 2 years' time. So there's optimism about sub-Saharan Africans about their own countries, and I think that gives us reason to be there and to share that optimism. We've been underwriting risk a long time on a South African exporter to Africa basis. We're busy expanding our offerings so that we do more Africa to Africa. So for example, in Botswana, doing trade credit insurance for Botswana companies in Botswana, for Kenyan companies in Kenya, and so on. We're able to do that through the Old Mutual network. We're part of the Old Mutual group and the alliances that we've built up. So we're expanding our offering into Africa so we can walk with our policyholders as they themselves establish operations in those countries. Where do we see lower risk and opportunities? I think I've mentioned the countries which we see as lower risk. The sectors which we think promise good returns at a lower risk profile is agri, technologies, food, IT. We find computer network infrastructure into Africa is flying. Mobile telecoms is doing well. Automotive's doing well. So there are parts of those economies that are really driving demand and doing quite well. Still higher risk in steel and construction. And that's where we've seen our claims activity. So we just urge a little bit of caution there. And then maybe 4 last lessons that we've learned, perhaps at a cost sometimes, is that I'll leave you with in closing. Is firstly, don't generalize about Africa. You need to underwrite country by country, risk by risk. So generalizing can be dangerous. It can paint you into a corner. There's been winners and losers as a result of this commodity and energy price decline. It's not a blanket phenomenon all across Africa, but there have been some quite severe losers. So be cautious of those countries. And then for those of you who work for large financial services groups, I'm struck by how the investment sector saw problems coming in oil and gas long before the risk underwriters saw it coming. So the portfolio managers were already down waiting out of energy while the risk underwriters were charging ahead. And I'm not necessarily referring to credit guarantee. I'm just saying around the world we've seen property casualty underwriters even ignoring the fact that there's looming problems on shale gas. And with the oil price falling, many oil producers, becoming uneconomic. So if you are part of a large group, talk to each other, share information. Don't operate in silos. Then the third risk is when you underwrite, the tendency is to look at the microeconomics, the balance sheet of the buyer, and sort of do your ratio analysis and do your projections off that. Yes, do that, but I think stress test your assumptions against macro shocks. Say, what could happen in that sector, and will this company survive that type of macro shock? And it's important to try and get your mind around the next big surprise. Can the company survive the shock? Does it have a strong parent company? Are there multi-territory operations from which US dollars can be sourced in an emergency? Important to think about those macro shocks. And then lastly, just around information. So and many companies struggle with the aspect of information. How the banks do this, the banks also struggle. They want to lend, but where do you get information? We want to insure trade credit, where do we get the information? Sometimes the financial statements in a traditional Western sense of IFRS quality, just not available. You'll get that from local subsidiaries of international companies, sure you'll get it, but domestic companies trading in Africa, often you can't get that, that reliable type of financial information. So how do you do your underwriting? We think there's no substitute for face-to-face assessment. So you need to go there. You need to meet management, understand their story. Does it make sense? Do they have the capacity to execute? How invested are they, not only from a capital point of view, but emotionally, from a market share, from a family point of view, in the territory, are they going to be around? And then to network in that industry. So typically the markets in Africa in particular sectors are smaller. So you can get together with the players and have a conversation about that particular buyer. What's their reputation? Do they meet their obligations? What's their payment behavior? How do they conduct themselves? So in a way, you're gathering underwriting information, you're making credit decisions, not only on hard financials, but these softer issues which we've found are very, very, very important, and sometimes there's no substitute for them. Well, thank you very much and enjoy the rest of the Moneyweb day. Thank you.